Hello traders and welcome back. I'm Natalie MacDonald and you're watching Sydney Direct on Dukascopy TV. Now we all know that Q3 has been all about that US Fed uncertainty and concerns over China's growth. But what could Q4 bring for the savvy investor? Well, I spoke to Grant Forster, CEO of Principal Global Investors, to find out his thoughts on the final quarter of 2015. Grant Forster, welcome back to Dukascopy TV. It's a pleasure to receive you once again.
Thank you for the invitation.
That's no problem at all. So let's start then with a look at Q3, which we are rapidly reaching the end of. Now, this is typically the seasonal slow summer period, but Q3 really has had some heavy macro drivers. Has this changed that seasonal pattern too that we usually see with investors, or how would you characterize the quarter?
Ironically, the seasonal pattern more or less continued. Actually, volumes were up sharply on the year before for the same time period, but nevertheless light. And what's happened is you've had all these significant macro factors, concerns coming in, and you've got a traditional time of summer where actually many investors are more risk off as summer break comes on. So you've had a lot of serious significant macro inputs at a time when investors are already risk off and volumes are traditionally lighter. So you've had a situation where liquidity became tighter, some investors in margin call situations. So when that happens in markets, liquidity's tighter, directionally things are moving fast. You actually got an exacerbated downward effect as a result.
So what are those trends then that you see perhaps transitioning into the fourth and final quarter of the year?
Well, the key trend is the Fed and when will they move, which is markets are so focused on this. We think it will. The Fed funds rate will move up. It might surprise people and only move up by 5 or 10 basis points to begin with. I think we're all locked in this idea of 25 bip moves, but pre-2006, you actually had the Fed move much smaller amounts. Of course, you had a lot more inflation and other forces going on at that point. But that's the key. They're also licking their wounds. The quarter did have some pretty tough equity returns. Fixed income spreads widened. So investors are either licking their wounds, wondering what to do next, or perhaps some of the more astute ones are picking more exposure back up in some of those areas they've liked and seen overpriced for some time.
You touched there on the US Federal Reserve and that uncertainty. Alongside that, we've also had China really fueling uncertainty within the markets. A lot of investors did in fact see a slight drawback. We saw volumes really very light for this season. Did this help to stem investor losses? What sort of returns were investors actually seeing on the ground?
As we know, for the longer term investor, those losses are paper losses, but they're real. They impact behaviour. So certainly, pension funds, large global investors, they are down over the quarter, but taking perhaps a more nuanced view, they're probably back to flat or marginally down on a year-to-date or 12-month basis. So we forget with some of the macro issues going on that the last 3, 4, 5 years have been pretty good for investors. Returns have been pretty good, perhaps fueled by quantitative easing globally, but not bad. So if we've seen a pullback in some markets, 10% equity revisions from the peak, it's not a bad thing. I think with respect to China, one thing we have seen is some of those service numbers start to improve, i.e. some of that transition from infrastructure, manufacturing, over to the service side, the financial services, the education sector, is just starting to emerge. So I think in a longer term sense, it's not all gloom and doom there.
Now, lastly, then, to bring it back to a more domestic focus, we've seen ANZ have come out with forecasts that they see the Reserve Bank slashing interest rates to a new record low of 1.5% next year. Does that match with your outlook for the Australian Central Bank? And again, how is that likely to shape performance?
Given that US GDP growth was revised up to 3.9% for the quarter, in that context, the notion that we might have 1.5% cash rates at some time next year tells me, A, sell the Aussie, and B, to keep buying your residential property. So I think 1.5 really in an Australian economy, which yes, it's nowhere near where it was during the boom times, but unemployment seems to have plateaued and maybe coming off a bit. It's hard to see in this environment why we need to get to 1.5% cash. As I say, the US will definitely be increasing rate, currency is going to strengthen, so I wouldn't see that need to get down that low.
Grant, thank you so much for your insights. Much appreciated.
Thank you, Natalie.
Our many thanks to Grant Forster, CEO of Principal Global Investors, for his comments. That's all we've got time for right now, but I'll be back with plenty more exclusive interviews for you right here from the heart of the APAC region. For now, though, it's goodbye.